Welcome to another gem of a video. Seriously, this is super high level stuff that you're about to hear. In this segment, I'm extremely excited to introduce to you a really good friend of mine and an absolute genius, Bobby. With over 2 decades of experience, Bobby has been guiding light to countless people worldwide, helping them protect their wealth and making substantial tax savings by correctly setting up their business structures, including mine. There's 2 parts to this video. One, I'm going to start out discussing protecting your assets in the USA. There might be a few variations for our Canadian friends, but the crux remains the same. Believe me when I say this. The insights you're about to get cost me a hefty $495 in a phone consultation just to make this video. Number 2, this is going to be everything Mexico. I think it's important to shed light on both of these topics here. Bobby truly is a wizard. You're gonna see. I guarantee you'll understand what I mean as the session unfolds. It's paramount for you to fully comprehend this information. And don't worry, I'm going to connect you with Bobby when the time is right after our calls and after you find the right property. Furthermore, I'm here to assist you with any questions that might come up. We'll discuss fideicomisos, the nuances of purchasing a property under a Mexican corporation, acquiring your residency, understanding your RFC, essentially your social security number here in Mexico, and a lot more. This video is packed with critical information, and I highly recommend dedicating a solid hour to watching it. This isn't just any video, it's specifically curated Zoom call that I arranged with Bobby for this section of the course. Trust me, the knowledge he possesses is unparalleled. It's rare to find someone who understands these concepts at a high level like he does. I cannot stress this enough. Do not skip this section. I would even suggest having a notebook at hand, jotting down your observations, pausing, and replay if needed. The information here is super high level, but it's an investment in knowledge that will pay off tremendously. So without further ado, let's dive in.
Really what I wanted to talk to you about is I have a lot of clients that come to our YouTube channel. You have helped me with structuring my business properly with real estate in the United States and then the business process here. I get a lot of questions from my investors that they come down and they think that, okay, I'm going to make these huge returns. And when push comes to shove, the tax implications and the tax conversation kind of gets put on the back burner because they're excited. They're looking at Tulum, they're looking at Mexico as, an investment opportunity. And then when the numbers come up or when they get to the table to signing or when we start the Airbnb page, it comes down to taxes. So I kind of wanted to go over what you helped me with and how we structured it. And then like the important things that someone needs to know from a tax perspective of investing in a foreign country and go from there.
Okay, roll with it.
Yeah. What you did for me was I have a property, and some of the viewers that watch this video will have properties in the United States, and they might not have even considered this. So what we did was we have 2 LLCs, one I think in New Mexico and the other one in Wyoming. I guess let's talk about that real quick. Why that? And what you do and how you protect things, and then we'll go from there.
So I think you're talking about the U.S. property. So in this case, the New Mexico and Wyoming, they have very specific purposes. And also in this case, because the property itself had a mortgage on it, you have what's called a due on sale clause in a mortgage. And what that means is you can Google search it, but what a due on sale clause is you have a mortgage and you want to deed it from, let's say it's in your name. Let's say you got a property in your name. Let's say you got a mortgage with Bank of America. In that mortgage contract, they have what's called a due on sale clause. And what that due on sale clause says is if you sell the property or change ownership of the property, they can call that mortgage, they can call that note and make you pay off the note upon the sale of the property. Okay, so the mortgage note is due on sale. And so if you own it in your name and you deed it over into an LLC's name, that's considered a change of legal ownership, and it gives the mortgagee, or mortgagor, sorry, the mortgage company gives them the right to call that due on sale clause, or, use that due on sale clause and call in the note to make you pay off the mortgage. So that's why you don't, if you own a property in your own name and you have a mortgage on the property, you can't put it directly into an LLC because it can trigger that due on sale clause. So the alternative to that is you deed it from your name over into a land trust, because a land trust does not trigger a due on sale clause. You can change the ownership out of your name into a land trust because it's what's called a revocable trust. And the presumption is you're the owner and now you're the beneficiary of that land trust. So it's not a beneficial change of ownership of the property, and it doesn't trigger due on sale clause. So the reason you do that is to get the property out of your name, because when it comes to asset protection, the first kind of step for asset protection is creating that veil of privacy around your assets. Okay. So I look at, think about your assets like a castle, right? If you ever been to a castle, like an old castle in Europe or something like that, what do they all look like, right? They all have a wall around the castle, and then most of them have a moat, around the wall, right? And so building an asset protection plan is kind of like building, the moat and the wall around your assets, the castle. And step one of that is privacy. So you've got this high value asset, like a house or, a apartment building or, vacation property or whatever. You got this property, it's in your own name. Well, that's not good from a privacy or an asset protection standpoint, because anybody can go in public record and see you own it. They can find your name, your personal information, your contact details. They can see you own it. So step one is to get your assets out of your name. John D. Rockefeller is famous for the quote, "Own nothing, control everything." That actually used to be across the top line of my website before we redid the website, was the Rockefeller quote. But that's the idea, is you don't want to own it in your own name. You want to control it, but you don't want to own it. So step one is to get the asset out of your name. And that's any asset, any value asset whatsoever. And I take that a step further. I don't want to get off on a tangent, but I take that a step further. I don't even own cars in my name for privacy reasons. But in your situation, what we did was very specific, because you owned a house in your name that had a mortgage on it. And so we put it into a land trust so that it's no longer in your name. Okay. So that's step one. That's taking your name out of public record. So now let's pretend like Nick gets sued for $2 million. The lawyer goes to find out what Nick owns. Looks like Nick doesn't own anything because we can't find anything in public record. Okay. That's step one, to make you look poor in public record. Okay. This is what you want. You want to look poor in public record. You want to look like you can't afford to live under a nice bridge, right? You want to look like a bum in public record. You don't want anything to pop up that says, you own a couple of $1 million or a few $1 million worth of property, or you've got a Lamborghini in your name, or, those types of things, right?
Which I don't have a Lamborghini.
So you don't want that stuff, though. I mean, if you have a Lamborghini, great. Then put it into a Montana LLC. And then if anybody sees you drive by, hey, was that Nick? Oh, I got his license plate. Let's run his license plate. And everyone thinks, oh, only the police can run your license plate. Yeah, whatever. There's websites out there that'll let you run people's license plates. It's not a big deal. But I run the license plate and I found out, that Lamborghini is owned by XYZ out of Montana. Well, we'll just go to the Montana Secretary of State and see who owns that LLC. And then I go to the Montana Secretary of State, I pull up XYZ, and I don't see anybody's name associated at all. So that's what I'm talking about, is keeping your name out of public record. So for real estate, never own your property in your own name. If you have a mortgage, like a personal mortgage on the property, then you're going to have to use a land trust. And then you name an LLC as the beneficiary. In your case, we used a New Mexico LLC as trustee of the land trust. And then we used a Wyoming LLC as the beneficiary of the land trust. So even if somebody were to ever get a hold of your land trust document, which it's not public record either, but somehow if they magically got it in their hand, your name is still not on it because the beneficiary is going to be, beneficiary LLC.
Yeah.
Okay. So from a privacy standpoint, you never want to own anything in your own name. Nothing. Ever. Not your car, not your motorcycle, not your home, not your rental properties, not your brokerage account, your stock brokerage account, not your crypto. All of that stuff should be owned in some entity's name. Like I said, either a land trust for certain circumstances or an LLC or, depending on the circumstance. And every situation is a little bit different, but you want your assets to be owned by other entities so that you look poor in public record.
Yeah. Yeah, that's the goal. And then, okay, so now, obviously, you helped me do all of this. So whoever is watching this, they could reach out to you. Now, for this specific discussion, for someone that is coming from the United States or Canada or anywhere outside of Mexico to purchase some sort of land or an Airbnb property here or something like that, how could you help them structure their taxes for saving money, right? So for me, for instance, I have my residency and I have my RFC. That RFC allows
Mexican residency.
The Mexican residency and the RFC.
Yeah, which is so for people listening, RFC is the tax number in Mexico, the tax ID number.
Yeah. And so that has allowed me to basically reduce my taxes withheld by Airbnb from 34% to, I think, 12%. It's 8% VAT and 4% MX that they withhold. Mm-hmm. What is the way that you could help somebody that's investing from a foreign country, whether it's the United States or Canada, buying a property here in Mexico, for their benefit, just in both wealth protection and as well as like reducing their amount of taxes that they have to pay, or any sort of thing like that?
So of course, I know you know this, but for the listeners, if you were a non-Mexican citizen buying property in Mexico, foreigners are not allowed to own property within 50 kilometers of the coastline or 100 kilometers of the borders. So Riviera Maya area, like Cancun, Playa, Tulum, that area, you can't own property in your own name. You can, however, own it one of two ways. You can form a bank trust. So you have a Mexican bank be trustee of this trust, and you would be the beneficiary of that trust. So that would be the way you would own property. This is what most people do. The other option...
That's the fideicomiso that I have, right?
Correct. That's the fideicomiso. And then the other option is you register a Mexican company or Mexican corporation, you fund that company, and then that company buys the property, and you can be the shareholder of that company. There are pros and cons to both of those. Most people go with the bank trust. It's usually quicker, it's easier. It takes quite a while to register a Mexican company as a foreigner. It takes a long time. But so just to clarify that on ownership, if you're a non-Mexican citizen, you have to own property. If you're buying in that Riviera Maya area, you have to buy it either through the trust or through a Mexican company. So that's step one. Step two, if you're going to be buying it for income purposes, you want to put it on Airbnb or VRBO or Expedia or something like that as a rental property. It really would be in your best interest to get residency. Get your Mexican residency, either temporary or permanent residency in Mexico. I don't want to go into all the details on that. That's a full video we could do on getting residency. But the benefit there is if you get residency, then you can get your RFC number, which lowers, it's about 1/4. Your tax rate drops by like 75% or something like that.
That's what that is.
Yeah, so your tax rate drops by like, I think it's like 75. What did you say? Or 30
like
something?
34% they withhold, and then it goes. So
okay,
34% to 12.
so like 65%. Okay, yeah. Just quick math off the top of my head. But your tax rate drops quite a bit because if you list that property, we'll use Airbnb as an example, since, if you're doing short term, you're going to have to be on Airbnb. Airbnb already has the relationship with the Mexican tax office. And if you are a non-resident, then they withhold the maximum amount, which is the 34%. If you're a resident and you have an RFC number, then they withhold the much lower amount, and they automatically pay that tax on your behalf. So first thing, right off the bat, you're gonna increase your ROI on a property just by becoming a Mexican resident.
Yeah,
like that. Your ROI goes up dramatically just by saving a huge amount in tax by being a Mexican resident. So that would be step one if you're buying a property for income purposes. Step two, of course, is you need to, talk to Nick and his team and help or find a lawyer. Sorry, not help, but find a lawyer who can help navigate this process for you to make sure you get that trust done. If that's the route you take, there could be the option to do a Mexican company. If you want, you'd need to plan ahead. Like you'd want to go ahead and register. If in the next 6 months you want to buy a property, you need to go ahead and register the company now because it'll take you a few months to get that company registered. There are some benefits to that. In some ways it makes things a little bit easier because if later on you decide to sell the property, which of course you probably will at some point, the big benefit is you can actually sell the shares of the company instead of selling the property. The reason why that's a big benefit is you don't have to pay the property transfer tax.
Just wanted to jump in here real quick about a very important update regarding the transfer tax. After speaking with a lawyer and a notary, I've clarified an essential point about the Fido Comiso route, specifically when you have your residency and your RFC. Did you know that under the arrangement, you're eligible for a tax exemption? That's right. You get a sweet deal of roughly around 5 million pesos, or for this example, let's just say 300,000 US dollars tax-free. I didn't do the conversion, but now that's not something to overlook. $300,000. Imagine you're selling your property for $500,000. You're not paying tax on the full amount with your residency and your RFC. No, you get the first 300,000 or 5 million pesos tax-free. So your tax is calculated on the only remaining 200,000 or the difference between that 5 million pesos. Now, bear in mind, this percentage can vary depending on the municipality or the state, but that's the gist of it. It's crucial info and just highlights again why getting your residency is super important. That's a quick update I wanted to share. Now, let's dive back in.
If you sell a property, like let's say you have it in a trust, and let's say I buy Nick's property and it's in a trust and I create a trust, we're actually changing the ownership from Nick's trust to Bobby's trust. And so you have to pay a transfer tax when you transfer ownership of the property. However, if Nick owned that property in Nick Incorporated, and I decide to, instead of buy the property, I buy the shares of Nick Incorporated, I would pay Nick however much he's selling the property for. I would pay Nick X number of dollars, buy the shares of Nick Incorporated. Now I'm the shareholder of Nick Incorporated. The property actually never changed ownership, so we don't have to pay any tax on we don't have to pay the transfer tax. Okay, so if you're buying for investment purposes and this is something you're going to sell, or you're going to flip, or you're going to sell in a few years, it would make sense to do a corporation because it'll save you a ton of money later on when you go to sell it. Okay. And you could actually you might be able to get a higher sale price if it's in a corporation also, because the buyer knows they're not going to have to come up with additional money to pay a transfer tax.
Yeah, that's true.
Okay. If you're buying a property, like you just want to buy a condo for you to live in at the beach, or vacation property, and you don't have any plans to sell it for the foreseeable future, then a trust is completely fine. Yeah. Or if you're in a hurry, like you found a property you want now, the market's hot, and you've got to act now, then I think you kind of don't really have a choice. You kind of have to do it in a trust because the corporation takes a long time to get done. But if you pre-plan the trust, if you pre-plan, the Mexican corporation does make a lot of sense. It can save you a ton of money, years down the road if you pre-plan for it. So having your Mexican residency saves you on the income tax. And then with your Airbnb account, I would recommend having a U.S. LLC to own your Airbnb account. So create a Wyoming LLC and then create your Airbnb account in the name of the Wyoming LLC and list that property on Airbnb in that property in your Airbnb account. So that way the payments from your property don't go to your Mexican bank account. They go straight to your Wyoming LLC bank account in the U.S. in U.S. dollars. So you avoid the Mexican banking system altogether, and then you limit your tax to just what they automatically withhold on there. And like I mentioned before, they automatically withhold much less if you have an RFC number as a resident. So that would be what I would do if I were going
to. That's what I did, and you set that up for me. So I have a question, because a lot of people ask me this: is we can't be double taxed based on the there's a treaty or something, I forget.
Tax treaty. TIEA, Tax Information Exchange Agreement.
And so depending on if someone is watching this, or either they're self-employed or they have a W-2 or whatever, they fall within a tax bracket. Let's just say 35%, just for the number's sake. If we're paying 12% in Mexico with the withholding from Airbnb, and we have the LLC like I do in Wyoming receiving the money, we don't get double taxed. And so can you explain exactly the double taxation? Because we still have to pay in Mexico, and then we also still have to pay in the United States. But from my understanding, I mean, there's a lot of stuff. There's the FEIE, there's a holding company option for it. There's all kinds of different things.
So in this case, you would take, in this specific example, you would take what's called the FTC, or the foreign tax credit. So let's use a real number here. Let's say you had $10,000 in profit from your Airbnb rental, okay? And you paid, to Mexico, you paid 12%. So you paid $1,200 in tax to Mexico. And in the U.S., you would owe $10,000. Yeah, you'd owe $3,500 to the U.S. However, when you file that U.S. tax return, you file what's called a foreign tax credit, and you show where you paid the $1,200 already to Mexico. So then you only pay the difference to the U.S. So you pay the difference between $3,500 and $1,200. So you'd pay $2,300 to the U.S. if you filed that foreign tax credit.
Okay, so that's where you get covered by not the double taxation.
Yeah, you wouldn't be double taxed, but you would pay the balance of it in the U.S. I mean, like you said, in your example, you're at a 35% tax bracket. So just to make an arbitrary number, but you would pay the 35% minus the amount you already paid to Mexico.
Now, if you didn't have your residency and they were keeping 34%, you'd pay 34% in Mexico and then 1% in the United States?
In that case, yeah.
And so I guess there is still a savings by getting your residency, because you get the money up front first, and then you can pay it back at the end of the year.
Sure, but keep in mind with real estate, as you well know, Nick, in real estate, you can reduce your taxable income pretty dramatically when you start writing off like depreciation expense and, accelerated depreciation on different things on your property. Like if you ever do an accelerated depreciation schedule for your property, I don't know if you've ever done that or not before, but if you analyze a property, you can do an accelerated depreciation where, let's say, for example, maybe appliances like refrigerators and range and stove and microwaves and all that stuff. Maybe, I don't know this off the top of my head. I'm not an accountant, but let's say the depreciation schedule on appliances is 5 years. Well, and let's say you paid $300,000 for that property, and they say, well, you've got $30,000 worth of appliances in there. So what you can do is you accelerate the depreciation on the $30,000 of appliances over 5 years instead of 27 years. So residential property for U.S. depreciation, you depreciate over 27 years. So what a lot of people do without like going into really thorough research on this, they say, well, I paid $300,000 for the property. I'll just depreciate that property at $300,000 over 27 years. So you just kind of divide 300,000 by 27, and then you just depreciate it like that. But see, you can do much better than that if you do an accelerated depreciation schedule where you take out specific things like light fixtures, for example. Maybe you can depreciate those over 3 years. Maybe plumbing equipment like toilets and sinks and all that stuff. Maybe they depreciate over 10 years instead of 27. So you take a much faster depreciation and you can write off a lot more and a lot faster over. Okay. And so that works out pretty good if you do an accelerated depreciation schedule. So my point was, it's pretty rare, like if you take full advantage of all the things you can write off as a real estate investor, you generally don't owe that much income tax in the U.S., if any. In a lot of cases, you end up being in a tax loss every year in the U.S. So keep in mind, if you pay 12% in tax to Mexico that's automatically withheld, that's an expense to you in the U.S. That foreign tax credit is an expense to you. So if your tax, like let's say you actually made $10,000, but after you depreciate everything and wrote off all your expenses and deducted your $1,200 in tax you paid, let's say you're actually negative $3,000, you can actually take a $3,000 loss on your U.S. tax return on that.
Okay. Yeah, I see. And then, okay. Yeah, that's cool. So I think I have one more question. That would be, if someone were to purchase a home, get their residency, like I do, whether or not they live here or they do, I live in Mexico full time. There's something called the FEIE, the foreign exchange exclusion, foreign
earned income exclusion.
Okay.
Foreign earned. So the critical thing there is earned. The second E in there, or the first E, the second letter, foreign earned income exclusion. But the key word there is earned. So I think where you're going with this is, how do you take advantage of the FEIE, right?
Yes.
So if you're a resident in Mexico and you want to take advantage of the FEIE, are we talking about Americans? You want to?
Yes, I would say Americans and then maybe Canadians, but mainly Americans.
Yeah, so FEIE is only Americans. Canadians have a whole different situation. Germans have a whole different situation. Every country is different. So FEIE is specifically for America. That's why I asked you, we talk about Americans.
Yeah.
So, sorry, I guess that was kind of a redundant question because, yes, we're talking about Americans. So for Americans that want to take advantage of FEIE, there are two ways to qualify for FEIE. What you get if you qualify, we'll go over those two in a second, but what you get if you qualify for year 2023, your first $120,000 in earned income, you don't have to pay tax on it in the U.S. And then you have a housing allowance on top of that Depending on which country you are in, it varies. You have to look at Form 2555 to see the excludable amount based on the country. But for Mexico, it's about $40,000. So basically, you can earn about $160,000 tax-free if you qualify for FEIE as an American, okay? Now, the ways to qualify, there are two ways. One is called the physical presence test. So you're physically out of the U.S. 330 days in a 12-month period. Now, I'm clear on the language. It's a 12-month period, not a calendar year. The reason being is if you say, I am moving to Mexico on July 1st, you can actually prorate that half of the year. So you get a prorated amount of that 120,000 plus a prorated amount of that housing allowance of 40,000 for the year of 2023. If you were leaving on July 1st with the intent to remain out of the country 330 days over the next 12-month period. Okay?
Okay.
And the second way you can qualify for FEIE is what's called the bona fide residency test. And that requires you to become a resident, a legal bona fide resident in that other country. So using Mexico as an example, to become a resident of Mexico, number one. Number two, you have to consider Mexico from the U.S. perspective. You have to consider Mexico your primary home. In other words, you can't have intent to return back to the U.S. So some things there, like for example, let's say you were hired by a company and you had a 2-year job contract to go live in Mexico City, but it was a finite contract, 2-year period. Well, the U.S. won't consider you a bona fide resident of Mexico. Even though you're gone for 2 years, they're not considering you bona fide residency because you have a finite contract. But if you work for yourself, you're self-employed, or you're a freelancer, or you're retired, or whatever, then you don't have that restriction. You can choose where you're spending your time, right? So you don't have that restriction on having that finite period of being out of the country. So the main things are, as an American, you cannot own a primary home in the U.S. That does not mean you cannot own property. You can own a secondary home, a vacation home. You can own investment property, raw land, an apartment building, a triplex, whatever you want. But from a tax perspective, that home in the U.S., if you own a home, that home cannot be considered your primary residence. For tax purposes, you have to change your primary residence to Mexico. Now, from a tax perspective, like one kind of negative consequence to that is, let's say you've owned your home in the U.S. for 10 years, and just for math's sake, let's say you bought that thing 10 years ago for $100,000 and now it's worth $500,000. Actually, let's say it's worth $600,000. So you have a $500,000 increase in the value of the property. If it is your primary residence, you can sell that without having to pay capital gains on your first $500,000 in gain. If it is not your primary residence, you do not have that exemption. You have to pay capital gains on the sale of that property. So if it were me, as an American, and I was going to move to Mexico or live partly in Mexico, if it were me and I owned a home with a large capital gain, I would want to sell it while I was still considering that property to be my primary home, so I don't have to pay capital gains on that property. Now, this would be a fun little hack, but if you owned it outright, create an LLC, sell it to yourself, sell it to an LLC that you own, okay? And then you don't have to pay the capital gains on it. You don't even really need to do a money transaction, but it just raises your cost basis on the property up also. Okay. So basically, if you bought it for 100 and you sell it to an LLC you own for 600, you have 500,000 capital gain while it's still your property. You sell it to an LLC that you own. Now it becomes investment property, but you don't pay capital gains on it because it's still considered your primary residence. And now going forward, your cost basis is 600,000 instead of, 100,000. Okay.
Nice.
So that would, if I wanted to keep the property, that would be what I would do. So basically, you have to give up your primary residence, so to speak, and you have to give up, like, it's to qualify for this bona fide residency, you can't have these connecting factors that show your intent to return. Like, for example, if you had, let's say you're from New Jersey and you had health insurance with an HMO that treated you only in New Jersey, for example, a specific doctor network in New Jersey, and you decided to keep that health insurance and you get audited by the IRS, they might say, well, that health insurance shows you have an intent to return back to the U.S. for medical purposes. And so, maybe you're not really a bona fide resident in Mexico. So you might want to think about small details like that. But the big thing is owning a primary residence in the U.S. That's the big one. Now, the cool thing is that if you qualify for bona fide residency, you don't have that 35-day restriction like you have with the physical presence test. You have a lot more flexibility on the amount of time you can be in the U.S. There's not actually any set rules specifically on it. It is all about your intentions to remain connected to the other country and disconnecting from the U.S. But kind of the general rule of thumb is you don't want to be in the U.S. more than about 3.5, 4 months a year.
Okay. All right. And then one last thing.
Let me add something. Let me add something real quick to this here too. So, like, I've just had a couple of consultation calls this week, and like, they didn't realize this. Like, a couple of guys, they didn't realize this. Like, one guy I just had a call with yesterday. He was making about $285,000 a year, and he knew he got the FEIE limit on his income. And he's a freelancer, by the way, freelance guy.
Wow, that's pretty good.
Yeah, he's tech space, some kind of like high level programmer guy. But he's a contractor, freelance contractor for some, I don't know the company, but some, high level, freelance position.
Corporate level or executive.
Well, no. He's a freelancer. He's a contractor. They pay out a 1099. And so what we did, and he didn't realize this, he thought, okay, well, he'll save the 120 plus the housing allowance of 40, and he'll just pay tax on the difference. Well, what he didn't realize is, and this is what we're doing for him. We just had this call yesterday. We're going to create a company for him. And so now, instead of them paying him personally, they're going to pay his company.
Okay.
And now from his company, he's going to pay his wife a salary of 120. He's going to pay himself a salary of 120. And they take a family housing allowance of 40. So actually they get 280.
Wow.
In tax-free income. So basically, in his mind, he thought he would be paying tax on 285 minus 120 is 165 minus 40, 140. He thought he's going to pay tax on like 140. But actually, he's going to pay tax almost nothing. Almost zero. Actually, he will pay zero because since he will now have a business, he can take more deductions as a business than you can as a sole proprietor. You're allowed a higher level of write-offs as a company than you are a sole proprietor. So he'll take more write-offs now to reduce taxable income, and then he'll pay each him and his wife a big salary and pick a housing. So he won't pay anything in tax. And like, I also had a client 2 weeks ago who had 2 teenage kids, and he was making about $500,000. And I'm like, pay your kids $120,000 each. So he's paying him, his wife, his 2 kids $120K each, $480 plus a housing allowance, tax-free, $500K.
It's amazing. And then you can even do something else where you open up another, like a holding company somewhere else. What does that do?
Yep. That's a good point. So I didn't go into that detail, but yes, we can do that. So basically, if you can take that a step further now. So for
that's what I have right now with my Airbnb property in Mexico is in the LLC in the United States. Getting the
income goes to the LLC.
I'm going there, but then it's in a holding company outside of the United States.
Right. So in your case, because you're primarily in a real estate business,
Mm-hmm.
that's considered earned income for you.
Mm-hmm. Mm-hmm.
If it were, let's say I had one rental house, and that's it, it would be considered earned income for me, and it wouldn't be excludable under the FEIE limit because I'm not a real estate professional. But you are.
Okay.
Remember, we discussed this for you
Yeah.
a couple
Yep.
months ago. You're a real estate professional, so you get that. If it were me, like, and I just had a rental house or two, I wouldn't be a professional. And so then it's considered passive income, and that would be taxable to me. But to your point, if it's earned income, and now your earned income flows through that Wyoming LLC, and if your Wyoming LLC is owned by an offshore holding company, so now the profits pass from, a Wyoming LLC, because an LLC is a disregarded entity for tax purposes, it's a pass-through. So that, let's just say 100,000 from the Wyoming LLC passes through. Now it's received or it's realized by your holding company, your offshore holding company. What happens is you pay yourself your salary from the offshore holding company, and you also avoid having to pay the social tax, or what I call social tax, which is Social Security, Medicare, Medicaid, or some people call it self-employment tax. But it's 15.3% on your first $147,000. So if you make anything 147 or above, then that saves you about $22,000 a year to put that holding company in place. If you qualify for FEIE.
Uh-huh. And if you don't, is that worth doing?
Let's say technically you could still do it. But it might be a bit of a red flag if, you're back to New Jersey. If you're living in New Jersey and all of your income comes from, let's say, technically a U.S. source, but you're paid from a offshore holding company that you also own. So that could be a red flag. But if you're living in Mexico, it makes a lot more sense that you're paid from a non-U.S. company.
And if you are living in the United States, then that's where like an S corp would come in, to where you're paying yourself from your business. Yeah.
So let me clarify the S corp point too. So there's no such thing technically as an entity called an S corp. There are corporations with an S corp tax election. And the reason that's important is you can also have an S corp tax election for an LLC. And an LLC is a much better entity for asset protection than a corporation. If you're sued, let's say you're sued for $1 million and you own shares in a corporation, and let's say that corporation has a bank account with $1 million in it, the court can take the shares of the company and basically kick you out of the company. And then as the new owner, they can drain the bank account to satisfy the judgment. Whereas if you had an LLC, they can't take ownership of the LLC, and they can't force any control over the LLC, and they can't force a distribution of assets. They're limited, if we do it correctly in the right state, they're limited to only getting a charging order against it, which doesn't really mean anything. I don't want to go into all the details of the charge. So the point is, I would rather have an LLC and just do an S corp tax election with an LLC than have a corporation with an S corp tax election, because you get the same tax benefit but better asset protection.
I see.
So,
wow.
So to your point though, on an S corp, if I was living in the U.S., yes, I would want an LLC with an S corp tax election, because let's say my business earned $200,000 a year. I would probably pay myself a salary of, let's say, $50,000, and then I would only owe the 15% social tax on my 50 and not the full 200. So I would save, well, I wouldn't owe it on the full 200 because you only owe it up to 147. But basically, you'd save the difference between 50 and 147, or almost $100,000 times 15%. So you'd save 15 grand on the social.
Wow. Yeah. So this is a lot. I know that whoever's watching this, they came because they're looking to invest in Mexico. That's what this channel is about. Found you from not paying my taxes for 2021 and 2022 on purpose, because I knew there was somebody out there that could help me, because I had been living in Mexico. It was just a matter of finding it. I didn't know what to Google. I didn't know what to search for. And so I spent a long time, like passively, not every day, Googling it, really trying to figure out who could help me to do this. From that, there's a whole nother side of what you have that I've been a part of for the past, 7 months now, is just a group of like-minded people. I'm not going to get too deep into it, but I think that would be something that whoever watches this, if you're looking to meet like-minded people, entrepreneurs, and anything that Bobby wants to add, we do have a really, really cool group. And Bobby is the one that, as you can see, has helped me do this, and I would imagine hundreds of other people, right?
But not thousands. I've been doing it for more than 20 years, so thousands. Yeah.
Wow. That was Bobby, a true master of his craft. I hope you have been able to gain some invaluable insights from this session. The information he has shared with us is truly extraordinary, and I'm confident it will help guide you on your investment journey here in Mexico to help you make the right decision when it comes to increasing your ROI. As I said earlier, I'll make sure to connect you with Bobby when the time is right, but for now, keep digesting what you've learned today. Keep your notepad close, and as always, reach out with any questions. And in the next session, I'll briefly go over your residency, how easy it is to acquire it, and help you with your RFC. See you later.